to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. So hi guys, welcome back to Macro Insight again. Today is the 27th of October, and let's take a little look at the charts. So, as usual, we'll kick it off having a look at equities. So let's bring up the S&P chart, see what's been going on. So obviously the market had a decent wobble after the weekend. So yesterday was quite a aggressive down day, but managed to recover, into the close or into the sort of later half of the session, like it often does in the US. So if we have a look at the S&P chart, and we kind of look at that rally that it staged from 32 up to those recent highs at 35.50. So it basically found some support around the 50% retracement of that rally. So that was going to, if you did have a look at what potential support levels you would be looking out for the market to hold, that 33.80 level was bang on the 50% retracement of that leg up. So that was kind of a prime candidate to find some support. And even though we overshot it intraday, it managed to, if you look at the hourly bars, for example, it managed to hold that level, right? So that's good that it held on the first test. Makes you think that, maybe that was enough of a retracement and the market can kind of, tread water or continue to grind back up before maybe the elections, right? So obviously the thing on everyone's mind is the US elections. That's what's kind of driving everything. So, that's kind of the main risk that everyone's kind of thinking about right now. Now, Europe was the one that was particularly weak. Obviously, one of the sort of reasons that's been touted as the reason for the sell-off was the increase of COVID restrictions across the EU. And then on top of that, you had SAP, big company in the index, big tech company in Germany, basically guiding lower on the back of COVID persisting longer than expected and the risk of further lockdowns and what's going on in Europe, basically, right? So the DAX took the brunt of it. So you can see, the DAX has been particularly weak and, going down towards that sort of 12,100 level, okay? Chart on the DAX not looking quite as nice, obviously, as the US. Europe in general, if you look at any European chart, the European charts have been struggling a lot more than the US. So this is going to be one to watch, because if the DAX can't stage a bounce and get back above this kind of 12,350 level, then there's a risk of that DAX chart really breaking down and us going back and seeing some serious lower levels towards the 11,000 level. So, I wouldn't be jumping in to buy the DAX here. Because that definitely looks like a weaker chart than some of those US indices. I was short the DAX. I covered it a bit too early. So I started covering it towards the 12,500, 12,400 level. Obviously, it went all the way down to 12,100, but I don't see the risk reward so great now as being short, given the sell-off that it's had. So I've covered my short there. I mean, we can talk a bit more about, what the main drivers and the narratives are for equities and the dollar over the next week or so. So you've got US tech earnings on Thursday. So you've got lots of earnings in the US, particularly this week. But the big tech mega caps like your Apples and Amazons and Facebooks, they're all reporting after the close on Thursday. So the market's obviously going to be watching to see how those stocks sort of behave. You've also got Q3 GDP numbers coming out on Thursday as well. Now that's going to be a massive headline number, somewhere in the order of 30%. Yeah. Now, obviously, that's just because we are recovering from a ridiculously bad Q2. So there's nothing to get too excited about. But what you probably will see is, again, Trump banging the drum on Twitter about how great the GDP number was and how great the economy's doing as a way of trying to, appear as he's doing the right things, basically, right? So now I don't think the market's going to be particularly caring what he says on that, but we'll see, right? If that number does beat or miss the expectations by 3 to 5%, let's say, then maybe that creates a bit of a short-term swing in the market. But yeah, I don't really think I think the market's kind of going to look past that, to be honest. Yeah. So the important thing is, what do we think on the election and the probabilities and the outcomes for the election? And so from what I've been sort of hearing, it's basically all about, if we're going to find out what the election result is on election night, it's going to be if Arizona and Florida go to Biden, right? So if Biden takes Florida, that massively increases his chances of winning the whole thing, right? So, and Florida and Arizona apparently will be counted on the night. So there are some other swing states that are going to be a bit slower at counting up the votes, things like, maybe North Carolina or Pennsylvania and things like that. So you might not know the results of those on the night, but Florida is kind of the key. And the polling suggests that it's quite close in Florida and Arizona. So they are the states that on the night will be the clincher. If Trump wins those states, then it's going to be a case of we won't really know the winner for a while, and we'll have to wait for all the other results to come through. And because of the mail-in voting, there'll be a delay. So you may not know for a week, maybe, I don't know if it would be longer. But if Biden takes Arizona and Florida on the night, then it's pretty much a done deal. So you can't, you're very unlikely to get a contested election if that happens. So that's kind of what to watch out for on the night, right? Now, in terms of what the market's pricing in terms of risk of contested election and stuff like that, well, there definitely are pricing in a risk, because you can clearly see from where the VIX trades, and this is the VIX term structure. So you've got the curve in what we call backwardation, right? So when you've got the short end volatility trading above the longer dated maturities, that's called a backwardation. When it's the opposite, when it's upward sloping, that's called a contango, right? So this backwardation is suggesting that there is a lot of short-term risk in the market right now. Yeah. Now, normally you get that sort of backwardation in the volatility curve when the market is actually moving, because the market's in a state of stress. There's been some sort of market shock, and it's kind of trying to find its new level, and the market's chopping around. Yeah. But what's actually going on is the realized volatility is at 18. So the 30-day realized volatility is at 18, the 20 days at 17, and the 10 days at 13, it says. Okay, so extremely low realized volatility, whereas the implied volatility, which is what the VIX tells you, that's trading at pretty much 30. Okay, so there's a volatility premium. That's what we call a volatility premium of about 10 vol points, or let's call it 50%, basically. Okay, so that volatility premium is telling you that the market is nervous, the market is, worried about some volatility on the horizon, and that volatility is the election and what happens in the aftermath of the election, which is, whether it's contested, whether there's some civil unrest on the back of it. All these things are keeping a bid or keeping a premium to the volatility surface. Okay, so vol is trading very, very expensive going into this event, right? Versus what the market's actually moving like, right? So I would say that on the back of that, the real opportunity at the moment in terms of trading, if you've got the stomach for it, is to sell volatility, right? Selling US index volatility to take advantage of this premium, because the truth is, and I've been saying this in previous videos, is whichever election outcome we get, it's not like 2016 where the market thought that Trump was a disaster for the market, right? And the market gapped down 5% on Trump winning. And then the market actually recovered that entire amount on the same day. But that was excess volatility, because that was something, A, that the market wasn't pricing or expecting, and it was an unknown that the market was scared of, basically, right? What we've got here is you've got Trump, which we've known Trump for the last 4 years. So it's not an unknown entity now. So there's no fear of that. You've got Biden, which is a, you know, kind of a back to a Obama style way of running the country, let's say, yeah, but with maybe a slightly more left tilt, yeah. But then on the back of that, you've got a load of really big stimulus coming if Biden gets in. Certainly if they get a blue sweep, then, you know, the market's starting to look to that as a 3 trillion stimulus package that helps Main Street massively. So, you know, you could get some quite positive market reaction to a blue sweep. And then you could also get quite a positive market reaction to Trump remaining in power with the Republicans in the Senate, you know, because then he gets to kind of do what he wants to do and is generally business friendly, right? So I think there's quite a lot of election outcomes which are quite market positive. It's just the market tends to not like uncertainty. And obviously something like a big election where we're not going to know who the president is potentially for even, you know, a couple of weeks after the election, that is what you call it. That's the definition of uncertainty, right? So if and when that uncertainty goes, I think there's a very high probability of the market having some kind of rally. It doesn't mean it has to rip straight through 3,600 on the S&P and take out the new highs. That's not, it doesn't have to do that. There's some sort of relief rally, but more importantly, volatility will get hit hard. Yeah. So volatility will implied volatility in the market will reprice itself down towards, you know, much more rational levels that are in line with the realized volatility. Right? And right now, that volatility is elevated by a factor of about 50%. Right? So that's what we're talking about. We're talking about implied. We're talking about that VIX curve coming in from 31, 30 in those front two contracts to maybe the mid to low 20s over the course of, say, 2 or 3 weeks. Right? That's the kind of scenario that I'm looking at. Yeah. So like I said, that's probably the biggest opportunity right now to trade is to sell volatility. Okay, and we'll talk a bit more about how you do that in smart ways and safe ways a bit later on. Yeah. You know, we talked about Bitcoin. We talked about how it was threatening to break out of this sort of 12,500 level last week. It did that. It took that level out and it started accelerating. And now it's at about 13,400. I had kind of flagged on Twitter as that break was happening. I did buy some. I bought some at 12,000, roughly 12,500. And my target zone would be around 14,000 on that. Yeah, that's just for that quick break and technical long. If you look bigger picture, if we get to that target zone, and it feels very much like we are because we're certainly heading there. But what gives me more confidence that we're heading there is the kind of decorrelation that we're seeing, right, between, say, the risk assets and Bitcoin. Right. So normally Bitcoin has some correlation to the S&P. Okay. But here we can see that we've had, you know, from the middle of early to middle of October, you've had Bitcoin breaking out on the upside and accelerating whilst you've had S&P just chopping its way down. So S&P breaking down and Bitcoin breaking higher is a bit of a signal that we might be, you know, setting up for the next significant leg up in Bitcoin, right? So, you know, I think breaking 12,500, there was a fairly easy trade to try and buy that break for a move towards 14,000, okay? And that's kind of looks to be in progress, yeah? If we get to the top of that channel around sort of 14,500, depending on how quickly it gets there, if that breaks, then that definitely opens up an area to 17 and then back to the highs at 20,000. So time frame wise, who knows? Bitcoin can do that in an extremely short space of time. It has a habit of doing crazy moves we've seen. But, you know, you'd probably be thinking around sort of at least, you know, end of November or maybe end of December kind of time frame to be hitting those upside targets of either, you know, 15,000, or if it breaks that aggressively and quickly, then you're looking at 17,000 to 20,000 area. But I definitely wouldn't rule out the prospect that it's going to get to 20,000 by year end. Certainly if it's decorrelating from the market. I think that's the interesting thing. When it decorrelates from the market and starts moving to its own beat and ignoring what equities are doing and what risk assets are doing, then you know there's something else driving this, right? And like, if you look at what the news flow has been, PayPal has basically started integrating crypto into their payments. You've had people like JP Morgan who have been historically bearish on crypto and bearish on Bitcoin, are now saying they're bullish and they see it as a good alternative to gold, right? So you had a lot of people kind of who before were kind of, not backing it, who are now changing their tune basically, right? So decent amount of endorsement coming for the space, right? And, you've had the guys at Real Vision banging on about crypto and Bitcoin for a long time now. And they're not about to stop. If anything, they're going to get louder as they get proven right, basically. And they've got a lot of people following them. So definitely some momentum building in that space. And I suspect that momentum will continue, right? So I mentioned that one of the biggest opportunities right now, in my opinion, for the next month is to sell vol, because I think vol is overpriced. So I think election vol is overpriced right now. So I think, how would I do that? So obviously the plain vanilla way to sell vol is to just sell straddles or strangles, okay? So one way you could do it is to just say November, where's the market at 3,400? So I could sell a November expiry, which is like 20th of November. You could sell that 3,200 put and a 3,600 call. And that's basically selling a strangle to capture the premium, because you don't think the market's going to break out of that range, basically. And you think vol's overpriced, and that vol will come in, basically, right? So that's one way of doing it. Now, that's a bit risky because it's so short dated that it's got quite a lot of gamma, which means if you're wrong and it does go through one of those strikes, then that can explode in value quite quickly, okay? But the flip side of that is if you're right, you're going to make your money quickly, because that premium of those options will go to zero very quickly, okay? Now, you could do a December similar thing. You could sell a December strangle. That'll give you a bit more time. You'll be able to pick strikes that are further away to earn the same amount of premium, and just have confidence that, yeah, the market might chop around a bit, but I don't think it's going to break the range, let's say something like 3,100, 3,700, something like that by December expiry. So you could sell that strangle as well. Okay, so that's one way of selling vol. Now, that is called selling vol naked, and that's a bit more risky than, that's quite risky, right? If you get it wrong and there's a big move and volatility spikes, you could lose quite a bit of money, right? So it's quite a risky strategy, particularly for a retail person, okay? So the way you mitigate that risk is by doing what we call condors or flies, yeah? So where you sell the straddle or the strangle, you then buy options that are struck further out of the money to limit your risk. So rather than just selling a put and a call, you sell a put spread and a call spread, right? So you know the limits to what those things can be worth, right? So you still collect premium, but you collect less premium, but you know you can't lose more than X, basically. You can't lose more than the distance between your strikes on the put spread and the call spread, right? So that's how I like to do it as a retail. When obviously now I trade retail because I trade for myself. That's how I prefer to do it, because it mitigates my risk. It requires less margin as well, because you've got a limit to how much you can lose, and it just helps you sleep easier at night. But you can still sell vol and you can still earn premium. Okay, so that's one type of way of doing it through it's called iron condors or iron flies, basically. And then the last thing is to play the VIX curve, right? So, if we say this VIX curve is just overpriced up here, then, how do we play a normalization? Well, we could say, well, we think December is going to go down, maybe towards the kind of 25 or maybe the 22 to 25 area. And you think January is probably going to, not get much below 26, okay? So you might end up with an upward sloping curve like this, which is what we normally have in the VIX, right? So if the VIX normalizes like this, then the way you make money off that is by going short December and long January. And now you can do that as a futures trade where you sell VIX futures in December and you buy January VIX futures. That's a bit more risky. Or you could do it via options where you buy puts on December and you sell puts in January or something like that, basically. So that's a way of playing the VIX term structure via futures or options on VIX, basically. And that's another trade that I have done myself. And I'm wondering whether or not to do in bigger size, basically, because the curve does look quite juicy, right? I'm very confident that these levels around 30 vol will not be there in 4 to 6 weeks time. 4 to 6 weeks time, I'm pretty confident that this curve will be more like the low to mid 20s, basically. So that's how I'm playing it, right? Obviously, that's just my opinion. And that opinion comes from being used to seeing these type of events and how the volatility often gets a bit overpriced and then how it then reprices post the event. I suspect a similar sort of thing is going to happen this time around. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.